What's ahead for our housing markets in 2025? That's what Dr. Andrew Wilson shares in this week's Property Insider Chat, our first show for 2025. We do a quick recap of 2024 and explain the various factors that are going to affect our housing markets in this new year. And then Andrew is going to share his forecasts, which, if you look back in the past, have been very accurate. So if you want to keep up to date each week with what's happening in our housing markets and the economy, please subscribe to this YouTube channel and click the little bell icon so that you can be updated each time a new show comes out. From interest rates remaining higher for longer than most of us would have liked, to strong population growth, to strong jobs growth, continued supply issues, the property markets in our economy throw both challenges and opportunities for us in 2024. So now that we're in the new year, 2025, what's ahead, especially for our property markets? That's what I want to discuss today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael, and Happy New Year to all. Here we are, 2025, halfway through the decade, Michael. So
Yeah,
that's
yes.
a
Gee, I remember when 2020 came and all the fuss that happened then. Well, I do want to talk about what's ahead for 2025, and we know that it's particularly difficult to make forecasts when you look at all the track record of others who got it so wrong a year ago. But let's have a talk about how the year finished off in 2024 first. You gave us your results from My Housing Market a couple of weeks ago, but let's recap how last year went before we move forward.
Well, it was a steady year, Michael. I mean, we expect housing markets don't really move in a volatile sense. You know, when we look at the trend, capital city housing markets we're talking about here. But we had a result just a little bit lower in terms of national prices growth, capital city prices growth over 2024. It was just a tick under 7%. Of course, we were just a tick under 8% the previous year, 2023. But that was the year following on 2022 when we had those first interest rate rises for a decade, and that affected the market, particularly confidence. But once confidence started to resurface, which it did in 2023, buyers came into the market, as usually happens in the cycle. Buyers come into the market first because they realise that there's value following a previous easing of prices, which we had in 2022. So buyers move in, take advantage of lower prices. Markets recover, and that's what happened in 2023. What was lost in 2022 was recovered in 2023. And then sellers start to realise, hey, this is a good time to get off sitting on our hands, get back into the market. And we then see an increase in listings, which we saw in 2024. And still plenty of buyers around. And we then built on that 8% growth in 2023, and we had around about 7%. So similar results there, but of course above the line now because it's not recovering from what we lost in 2022. That's what happened in 2023. We now moved ahead. So I think the prospects going forward, and of course it was assisted by a continuing 2024 was assisted by a continuing strong economy. We ended the year with the unemployment rate still below 4%. That's quite remarkable, Michael. In fact, the December unemployment rate was 3.9%. For December 2024, which was exactly the same as the December 2023 result. So we remained over the full year in the threes. So even though there were some signs that unemployment was starting to trend upwards, we still ended the year with a very, very low, historically low 3.9% rate. And by historically low, I mean anything with a 3 in front of it is historically low. And we do
and it's also got to be put in the context of more people in the workforce with a higher participation rate, as well as more people looking for jobs with a higher population, bigger population because of immigration.
Absolutely. And that's why it just didn't get any better, Michael, because not only do we have to go back to the early 1970s to see a consistent period of 3% unemployment rates, and that was a completely different Australia, single income families particularly, and a much lower participation rate. But our participation rate, which measures the proportion of the potential workforce, that is all those that could be working, that are actually working, right? and that's the highest we've ever recorded, still at a level just below the record recorded in September 2024. And as you said, in the context of the resumption of mass migration, and I can call it mass migration, even though it's eased a little bit, probably concerns the government have that we don't have the infrastructure, particularly housing, to match those high levels of migration. But still, what can you do? You're getting hundreds of thousands of more people coming into Australia, finding work. We've got the highest proportion of our potential workforce actually engaged in jobs, and we have the consistently lowest unemployment numbers, for 50 years. So that, of course, meant that the interest rates were on hold for the whole year. And even though, and we've been lucky enough to see, maybe lucky enough to see headline inflation fall sharply to under 3%, but a lot of that's been driven by the international price of oil, which is now half what it was of its peak and continuing to fall. And of course, the government handouts for electricity bills, which have caused a record fall in electricity prices. And that's been what's generated that low inflation rate, headline inflation rate. But the underlying inflation rate still remains higher than the target for the Reserve Bank, which is 2 to 3%. We're at 3.5% and rising for underlying inflation. So not a good sign there. And we do still have upward pressures internationally on inflation. So I wouldn't be counting in an interest rate cut too soon. But you never know what the future holds. But still, I still think that, the outlook, as we can see it with the current data, is clearly for interest rates to remain on hold. And given that we don't have the energy from lower interest rates or higher interest rates to make a significant change to housing market affordability, I think that we'll just see a gradual easing of prices growth this year, which is what we saw last year, Michael, compared to 2023.
Well, last year also was a very fragmented market. That's normal. There's not one Australian property market. There's not one Sydney or Melbourne market. So within each of the capital cities, things vary by houses, by units, by geography, by different price points. But there really, as we look at your figures here for the end of December, there were three outstanding markets for the year: Brisbane, Adelaide and Perth, Perth in particular, which had particularly strong growth. Sydney did well, and then the rest of Australia sort of struggled.
I think it's interesting when we analyse the results, particularly from the big five capital cities, Michael, which tend to be, less volatile, can we say, than the smaller markets, because of, the actual volume of activity. But I think that when we look at, I think affordability is the key here for the top four markets. When we look at the median house prices of Adelaide, Perth and Brisbane, and we compare that, well, until recently, with Melbourne and Sydney, they're still below, although not so much Melbourne, but still well below the Sydney median house price. And yet incomes in those capitals aren't too different. And I think that's the point we've got to understand, that affordability is positive in Perth, Brisbane and Adelaide, particularly compared to Sydney, because prices in Sydney are significantly higher and yet incomes are basically the same. And as we've said constantly here, one of the secrets of success of the Australian housing market is the market power that banks have, and that they do restrict lending, almost at the same levels through the cycles. So, and that means, your 80-20 loan to value ratios, restrictions on the percentage of your income that you can have for your mortgage repayment. And all this means that, it keeps a more steady environment for housing market activity. But having said that, affordability is important, and I think that's what's driven those big three boom markets of Adelaide, Brisbane, and Perth, is their affordability advantages, Michael. As I said, they have significantly lower prices than Sydney, and yet their incomes are around about the same, with the exception of Perth. The incomes in Perth are significantly higher than those in Sydney and the other capital cities. So that means there's upside from those affordability advantages, particularly that Perth has. And I think that will continue in a strong economy to drive those housing markets, particularly the Perth housing market. I don't think it can reach the levels it has over the past 2 years, but I still think that they will be the leaders in prices growth for both houses and units over 2025. And, you know, when we look at the migration numbers, Michael, also, we can see, interestingly enough, that there's still plenty of migration occurring into into Queensland, Western Australia and South Australia. So we shouldn't underestimate the impact of migration still on those housing markets, those capital city housing markets of those states that are still experiencing strong net migration. So it's not just migration from international sources, it's also migration from interstate sources as well, Michael. And that's all part of the picture that I think will continue to drive prices growth in units and houses in Perth, Adelaide and Brisbane, but not quite at the same levels as last year. And that's only because of affordability barriers, because, you know, we've got the Brisbane raw median house price, and I don't want to get into the difference between a raw and an adjusted median price, but the Brisbane raw median house price is now higher than the Melbourne raw median house price, Michael. So that just shows you that the affordability advantages are starting to close in. They won't close in that quickly on Sydney, as they have in Melbourne. But so that's my story on those sort of top 5 affordability or top 4 affordability scenarios. Now, that leaves, as usual, one that we've got to look at that sort of doesn't fit that model, and that's the Melbourne model, Michael, which has really, really been an outlier in that term, in that sort of sense of analysis that we've used. So, you know, the Melbourne economy is doing fine. Its migration profile, not quite as strong as it has been, but still strong, you know, migrants coming into Melbourne. Its rental market has picked up quite strongly now. There's been big rent increases in Melbourne. So yields have increased, Michael. But what's happened to the housing market? It's still tracking a little bit sideways, Michael. And I think that this is where we get to that you sort of the thing that you really can't measure or model, and that's confidence in that Melbourne market.
It's confidence in the housing market, but also in businesses. This Victorian government has taxed anyone that they can grab money from. So property investors, where they've changed legislation more in favour of the tenants and taxed them if your property's vacant for more than 6 months, or land tax changes. But also small businesses have had difficulty in Melbourne as well. Some people are putting it down to the COVID effect. I think it's a little bit more than that. So yes, we're going to need a change of confidence. Andrew, it reminds me very much of the early 90s when both you and I were in Melbourne, and there used to be a joke, last person leaving Victoria, please turn the lights off.
Yeah, I mean, look, that's interesting, Michael, and it is about confidence. I think the thing here is, when we look at what will change it, is that at that time Melbourne had an horrific economy. I mean, its unemployment rate was pushing 14%.
Very different to now.
14%, and yet the Melbourne unemployment rate now is at 4.4%. It's actually creating jobs at the second fastest rate of any of the capital cities, Melbourne. So it's doing okay. You can't point to the economy here being the reason. That's my point, that it's one of those things you just can't really nail, and that's confidence. It's mindset that, you know, that, and when we look at the breakdown of the various price profiles in Melbourne, it becomes even more, you can rationalise it in terms of confidence, because it's those higher priced inner city property markets that are struggling in Melbourne. Now, that's not typically a response to the economy, or even issues such as interest rate changes or wage rises. That's more a middle budget price market. Now, the middle market and the budget price market, you know, eastern suburb, sort of outer east in Melbourne, the northeast, the west, the southeast, they're all doing okay, Michael. They've had reasonable years over the past couple of years. There's still plenty of buyers looking for value options in those markets. But it's the inner east, the inner south, and the inner city markets that have struggled. Now, they're the markets that really, you know, are all about confidence. And they're the markets, they're not trading up, buyers are sitting on their hands. And it's interesting because I think there's two things that will drive that revival in confidence, Michael. And the first is obviously a cut in interest rates, because that will improve affordability. But more so, that will start to work on the budget and mid-price markets, because that will energise them, because they're more about those sort of aspirational type of change-up buys. But I think what will happen is, as those mid-price markets start to grow with perhaps a cut in interest rates, those buyers, those trade-up buyers, will start to realise, hey, we can afford now to get into those inner suburbs, which were off our sort of price list, and that will create I think, one of the sparks to people saying, oh, gee whiz, I can't believe how cheap prices are there. It'll start to move, and then people say, oh my God, they're starting to sell. And that's what we saw in Melbourne in the 90s, Michael, that once properties started to sell, in a subdued market, that created the fear of missing out. And it's the fear of missing out that will, I think, regenerate those areas in Melbourne. And I think that's coming sooner rather than later, because, prices are at points we haven't seen, for quite a while in those areas. And I do think part of what will drive the fear of missing out will be that the upgrader market from the outer suburbs or the middle suburbs will start to move into those inner suburban markets, Michael. And that'll be just that sort of that pebble that comes off the top of the mountain and creates the avalanche going forward. But there's absolutely no doubt that there's plenty of value opportunities in that Melbourne market. There's nothing other than confidence, in my opinion, that's driving that. Still a bit of a hangover from the COVID period. But as you said, also, there are responses here to recent government policies that are also acting to subdue that. But, that's why I've been perhaps a little bit more optimistic for Melbourne for next year in terms of last year, because I do think that is a value market. I think it's particularly the inner suburban markets. And I think it really reflects affordability advantages, which those parts of the market certainly have. And given the continuance of a strong economy, settled interest rates, in my opinion, and maybe even a cut, which I'm still not married to, that we'll get a cut. But let's say, particularly with this strong economy, that would be crazy stuff from the Reserve Bank. But as I said, I think that the Melbourne market represents some pretty good value next year. So I've taken a bit of a punt on Melbourne going forward, Michael, for those reasons I've just explained.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, clearly there's intrinsic value in buying established properties in Melbourne at the moment, because you couldn't replace whether it's houses or especially apartments at the cost one can buy them at. And in due course that will catch up. I guess the question is when that's going to happen. So now each year, for the last 5 years, we've been running these Property Insider chats. You've put your forecasts with your housing market barometer out to the public, and you actually put your forecasts on the line rather than having an each way bet like some people who say, if this happens, that'll happen. If this happens, you've got to get it right. If you put 4 different forecasts out, one of them's got to be right. But in your case, Andrew, last year's you've been pretty accurate, which is different to many. So where do you think we're going to end up in 12 months' time? How's the market going to finish off in 2025, and how are each of the individual markets going to go?
Well, I think we'll get, as I said at the beginning, Michael, around about a 5% increase in the national house price, which is down on the 7% odd that we had over 2024. And as I said, a lot of that is about the changes in affordability, because we're not going to have any significant increase in incomes or significant cut in in the interest rate. Although, there's still the prospect, I guess, even though I think it's reasonably remote, of an interest rate cut. So I think we'll get about a 5%. Again, it's very similar to last year. I think that given, as I've discussed before, those affordability advantages that Adelaide, Brisbane and Perth have for both units and houses, we'll see them being the leaders. Not as strong as last year, mid-price range, around about 8% in Perth, Brisbane and Adelaide for both houses and units. I still think that Sydney market has strength, around about 5%, maybe a little lower on Sydney. I think Canberra, as with Melbourne, is a good value market for house prices. And I think they'll look at a rebound there of around about 4 to 5%. A little bit optimistic perhaps there. I think the risks there are on the downside. And Darwin and Hobart around about where they were last year at 3%. Similar results there for units. Sydney again 5% increase, mid-range forecast. Melbourne and Hobart up 3%. Again, optimistic for Melbourne, but I think there's a lot of value, particularly in those Melbourne unit suburbs. But of course, we have the resumption of migration, which will increase demand, particularly in the unit or in the university sectors for unit rentals, which will push up yields, which will start to become, when yields in some of those markets in Melbourne, Michael, are 6-7%. So, that's really a green light for investors, those sort of numbers. Canberra, I also think, got some upside for Canberra, which has had a flat couple of years for units, around about 2%, in Darwin, which is volatile from year to year because it's a smaller market, up by around about 1%, Michael. So I think that the key, as you said, I guess when you're making forecasts, you can have all those variables, and it's like betting on every horse in the horse race and then declaring that you're a genius because you've got the winner. I'm not sure there's a lot of skill in that, but still we get that. But I think that the forecasting really for the housing market is about the variables, as we've already discussed. And I couldn't see, with a really strong economy, the Reserve Bank cutting interest rates, particularly with issues internationally that are showing a rebound in inflation, early days, however. And of course, a lot of talk from the new US government, new US administration, whether it'll happen or not, it's another story, about tariffs, and tariffs can always tend to be inflationary. So with the interest rate outlook looking sort of benign, and as I don't think they cut them, I question the interest rate cuts in the US. I'm not sure what the full story behind those were, given their economy is still strong. But nonetheless, their inflation rate is lower. So I would suggest that, the key here is a lower inflation rate, a lower interest rate, which may occur. Not quite sure the Reserve Bank can hold its powder dry. And we've got to mention one thing that may mean higher prices, Michael, not lower prices. And you know what is happening this year?
What's that, Andrew?
An election, Michael.
Of course.
So I think the government is very much aware of the angst in the community in regard to the chronic undersupply of housing. I think the relief that we've seen in our rental markets lately, and I wouldn't call it relief, but certainly rents have started to flatten off, thankfully, is because people have just given up rather than, any more supply coming in, which we're just really not seeing. And I think the government will continue, as they've done with the electricity handout. They'll continue to try to, fix the situation. So that might mean some stimulus for the housing market, Michael. So look out for that occurring in our election year, because I think they'll be primed to do that, because governments around the world, particularly advanced economies, are experiencing the same problems with house prices and rents, undersupply of property, and their electorates are all giving them the thumbs down, Michael. And I think the federal government will be well aware of that, and they might initiate some programs to help the housing market. So that will only mean higher prices, Michael. I don't think they want to go into an election with lower prices.
Well, first of all, they don't, the government doesn't want the housing market to slow down and crash or even drop a little bit because that's not going to be good for them. And all those stimulus packages the government brings out, one after the other over the years, they bring short-term benefits to those who take advantage of them, but in the long term, they just make the property markets more expensive. I guess they're kicking the can down the road, as one says, Andrew.
Got to get back in, Michael. That's the name of the game, and you got to do what it takes. So look out for
Well,
that, folks.
we'll be back each week to discuss that on these weekly Property Insider chats. Thanks, Andrew.
Thanks, Michael.